but then they go on TV and people treat these people with, kid gloves and like they're geniuses. And I think hard questions need to start to be asked.
So you refuse to call them stupid, which I'll call them stupid twice then. Welcome back to the Futures Edge podcast. I'm Jim Murio. As always, the brains behind the operation and the executive producer, co-host, Bob Iacino. Today we have CEO and founder of GLJ Research LLC, Gordon Johnson. Thank you a ton for coming. We really appreciate it. How are you doing?
Good. By the way, guys, I apologize for being late. Sunrun is a company I cover. It's a fire rod, and there was some big news there. I apologize.
Don't you never have to apologize to us.
We can start with that if you can.
If you want to talk about that, go. I can't talk about individual stocks because of my licensing with futures, so I'll sit it out. If you want to talk about what's the name of the company, Bobby can. Yeah.
We can talk about whatever you guys want.
All right, let's start with general macro so Jimmy can participate.
General macro, holy shit, is how we start with this week. My contention is that on Tuesday, the greatest market prognosticator on the planet, which is the yield curve, told us exactly what we needed to know when Jerome Powell came out and said, I'm going to tighten until the economy is bleeding from the eye sockets. And the 2-year went screaming on a panic yield bid, and 10-year just sat back calmly and watched it happen. And we traded down to a negative 109 inversion. Was it just as easy as that? The market said, no, you guys have gone too far. And then all of a sudden we see a bank failure. Put some light on it for us, will you, Gordon?
Yeah, so I think you got it right. I mean, Jerome Powell came out and did an about face. And, he said 25. They did, sorry. Can you guys see me?
Yeah.
Sorry. So they said 25. There had been multiple Fed speakers for weeks positioning the market as such. And then, we got data that suggested otherwise, and, he did an about face. And I think that is why, clearly the markets have sold off, but I think that, my view is that the Fed is not doing enough. And let me explain very briefly. I think what they're doing is actually adding to inflation. Let me explain. So right now, if you look at the short-term rates or the Fed funds rate, they're below CPI inflation. CPI inflation is sitting at 6.4%, which means real rates are negative. That's extremely inflationary, number one. Number two, you have a U.S. government that's running a massive deficit despite near full employment, which is unprecedented, which is uncalled for, which Jerome Powell should be telling them not to do, but he's not, and which is also very inflationary. So whenever CPI inflation has went above 5%, inflation didn't come down until the Fed funds rate went above CPI inflation. And the Fed funds rate right now is 4 and change, and CPI inflation is 6 and change. So I believe that whether it's 25 or 50 bips, it's not enough, right? The Taylor rule suggests that the Fed funds rate should be at 9% right now. But let me tell you why I think it's inflationary. The reason why it's inflationary is because think about it, right? 80 to 85% of the population is unaffected by stock prices, pretty much unaffected. It doesn't matter, right? We focus on stock prices because we're so, affected by it. But the reality is the bulk of the population is unaffected by it. However, the bulk of the population was getting 0% interest rates on their savings, call it 0.2% interest rate on their savings for years, right? No money on their savings. Now, all of a sudden, you can get 5% risk-free. So normal people now have an income stream they haven't had in years. And you could say it's not big, whatever, but I think that is driving them to go out and spend. And because the Fed isn't being truly a true fighter against inflation, people are going out and spending. So them allowing, and I think this is a good thing, but them providing, a fixed and reliable income stream, additional income stream to people that they haven't had for years, I think is inflationary. So because they're not being serious about the inflation fight, I think what they're doing is actually driving inflation.
So then you mentioned the government before. And by the way, if you want to bash the government, bash the Fed, you have come to the right place, my friend, because that's what we like to do. So the federal government, so you talked about the lower 80%. Let's even go the lower 50%. And all these government programs that are now and plan on pumping more money into the system. So in your mind, it's almost like a big circle. Everybody's affecting this adversely and pushing up inflation. Is that what I'm hearing?
Yeah, I think it's more so, again, the Fed has created a new stream of income that people didn't have previously that is driving them to spend more. And because they're not being truly restrictive, and let me make it even more simple. To be restrictive, you need to take the Fed funds rate above inflation, right? They haven't done that.
Yeah.
However, conversely, what they could do is, instead of doing this measly, modest runoff of the balance sheet, they could run down the balance sheet as quick as they ran it up and keep rates low. So that would kill asset prices, but it wouldn't kill rates. And that's, people are saying it creates these job prices. That too would reduce inflation, but they're choosing not to go that route.
So Gordon, do you think that when you say that running off the balance sheet will kill asset prices, do you think what they're doing right now, I think the recent runoff somewhere in the range of 600 to 800 billion, which is really nothing when you're talking about an $8 trillion, over $8 trillion balance sheet, right? So they've run off, let's just call it for the sake of being simple, 700 billion. But they've run up rates at least at the fastest pace since Volcker, right? So you're saying if they did the reverse, that would have more of an effect. So do you think that they're basically targeting a little bit of housing, a little bit of auto loans, and they know they're doing this? Or is this just stupidity?
I don't want to say stupidity. I don't want to call those guys stupid, but I just think that they've already made two big mistakes, right? I think that the first mistake was, so when they started the stimulus when COVID happened, right? They said they were data dependent. And if you go back to the global financial crisis, right, 2007-8, when retail sales collapsed, I think it took 3 years for retail sales to get back to trend. You go back to the global financial crisis, when retail sales collapsed, it took 10 years to get back to trend. The COVID recession, retail sales were 15% above trend 6 months into the recession. So 6 months into the recession, the data was screaming, stop. They didn't. They did another, 3 trillion, 4 trillion. In fact, the first 100 years of the Fed, their balance sheet grew by roughly 900 million. They did 3 trillion in 2 months with COVID. They did 300 years of balance sheet expansion in 3 months. So I don't want to say that they're stupid, but what they were doing, and we've been saying this ever since, was reckless. What they were doing was reckless. And then, so that was mistake number one. They overstimulated. Mistake number two was transitory. And I think, so that was mistake number two. So when people say the Fed is going to break something, in our view, they already broke something. They sent inflation to 40-year highs. We're broken, right? The normal people, not these rich people on Wall Street, not these hedge fund managers that go on CNBC, not the hosts on CNN who make $5 million a year. I'm talking about the real Americans, the people who, the backbone of this country, 80 to 90% of Americans who don't care about the stock market. We're feeling it. I'm feeling it. I go to the grocery store. So they already broke something, and that was the high inflation, but they keep making mistake after mistake after mistake. But then they go on TV and people treat these people with, kid gloves and like they're geniuses. And I think hard questions need to start to be asked.
So you refuse to call them stupid, which I'll call them stupid twice then. But I'm going to add to something that you said, but then I'm going to challenge you on something else, because you talked about the mistake they made. I will go to June of 2021. CPI had already printed over 5%. The housing market had gone absolutely parabolic. And yet they continued and bought 250 billion more just of the mortgage backs, not to mention a crap ton of other bonds as well going forward, while the whole time they're saying they're transitory. It was absolutely moronic, seemed politically motivated to me. Now, back to you saying they haven't done enough. Now we then have to rectify the last 2 days where in the blink of an eye, the interest rate market has taken out tightenings. They get like a 4 quarters out SOFR contract has taken out 100 basis points of tightening by the end of this year. The market is saying that they're breaking something the other way, perhaps a bank contagion. Or is it just a short position squeeze? That's what's pushing these rates back lower.
What's pushing the rates lower, in my view, is the failure of Silicon Valley Bank. And the failure of Silicon Valley Bank is not something it's not systemic. It's not suggesting JP Morgan and Citi and the US banking market is at risk. It's very simple. Silicon Valley Bank effectively was the beneficiary of 0.02% deposit rates, and they took on a bunch of customers, i.e., crypto companies and meme stocks and innovative companies that didn't make money. They made loans based on adjusted EBITDA numbers, right? These companies were hemorrhaging cash, but they gave them money based on adjusted EBITDA numbers. That is reckless behavior, right? And then they brought a bunch of bonds at very low interest rates because the thought was interest rates are going to stay low forever. So what happened, right? Now all their customers are no longer making any money, right? They're hemorrhaging money, so they're pulling their deposits, right? So Silicon Valley Bank has to fund that with what? What are they funding it with? They don't have any more money. They're funding it by selling their treasuries, but their treasuries have imploded in value because rates have went up, thus values have went down, and thus they go bankrupt. This is just, you had a bad business. They were just doing bad business, and thus they got caught with their shorts down. This isn't systemic risk. But because Silicon Valley Bank is going under, the market is assuming the Fed is now going to come in and be less aggressive, and that's why you have yields coming down.
Oh, I like what you're saying. So not systemic at all, too. But it's actually, then, aren't we saying that this is a good thing? If it's a bullshit business model that's just based on easy money, they're supposed to break them apart, right? And then, Bobby, you come in after that.
Yeah.
Yeah. Did you hear what I said, Gordon, or no?
Yeah, no, I'm sorry. What was the question? I need
the
to. The
question was, this is the way it's supposed to work then, right? If that's a bullshit business, they're lending stupid money at zero rates. They're supposed to be broken apart, right? They're supposed to be smashed with a wrecking ball.
100%. I agree.
Go ahead and take a minute and plug your thing in. Go ahead.
Yeah, 1 second. Sorry.
Plug it in.
Are you drinking booze, Bobby, or just water?
I think I had a heart attack this week. I'll talk to you about it
nice.
another time. Yeah.
Okay.
One of these days I'll go to the doctor and check, but I'm pretty sure I had a minor heart attack.
I've been taking these ice baths, and that's how I'm going to die, by the way. Because I talked to my doctor about it, and she's like, "Are you sure that you should be doing that?" Like, yeah, this is going to be fine.
Yeah, we'll be fine.
Yeah. But anyway,
Sorry,
I don't like
guys,
to have a
1
drink.
second.
No,
you're
don't worry, man. You've given us money's worth already. Your passion's freaking fabulous.
My phone's, hold up, it's about to die here. Let me just plug it in. All right, we're good to go.
Bobby, you're up.
Let's see. All right.
So
you guys
Jimmy,
gonna edit this?
yeah, we can still hear you. We can still see you. So we're all good. Jimmy's question.
By the way, there's no even need to edit it, Gordon. It's an informal talk. Our viewers are
dude, we
that.
don't
They
edit.
don't give a shit.
So unless you tell,
sorry to your viewers. All right, let's
no,
go.
unless you say something like, "Hey, can you do me a favor and not put this on?" Otherwise, it doesn't get edited. So real quick, Jimmy's question was: so bad businesses are supposed to explode. So this is a good thing that it happened.
Yeah, I mean, it's a good thing, but it's just, Bill Ackman and fabulous investor. I think, I don't know him personally. He's done very well. He comes out and he floats that, taxpayers should bail these guys out. We're dealing with breakneck inflation, right? We're dealing with homes and rents we can't afford, and we're dealing with uncertain job future, given these job losses are accelerating. The idea that us, the taxpayer, have to bail out another, millionaire gambler is just, it's absurd. It's absurd. I mean, it just really upsets me that, these guys are looking for handouts again from Joe the plumber, the guy who's just been completely lambasted over decade because of the explosion in wealth inequality, I believe due purely to reckless Fed policy.
All right, so I'm going to ask you a question now, but I'm going to sound like a member of Congress first, because first I'm going to give a speech here. Basically, Jimmy gets on me for this all the time. And
if you want to take a snooze in the first part of it, usually goes on long.
I'm pushing back a little on what Jimmy said earlier, Gordon. Okay, so Jimmy said that, rates just went nuts, and they took 30 basis points or 20 basis points onto the 2-year and all this. Basically, the 2-year note, from the beginning of the week to the middle of the week when it hit 505 settlement basis, was up 19 basis points. It's down 30 today. So like the idea that all of a sudden this week, the 2-year ran, I think is, and Jimmy, I know you watch interest rates, but I think you haven't been paying attention. From this perspective, the 2s10s yield curve first inverted April 1st of last year. And then it was inverted for April 1st through the 4th, went back to what not normalized, but it was still very, very flat, right? Then it inverted July 6th and has been inverted ever since. And ever since it stayed inverted and continued to go deeper and deeper into inversion, I, along with Mike Arnold, who I'm going to bring in a second, has said, I've said there's going to be a recession. It's just a matter of time. The average time from the first inversion to the following recession is 12 months. So if you take the April one, we're not even at 12 months yet. If you take the July one, the recession is not late. It's not even on time yet, right? It's not even time for the recession to appear. So Gordon, my question is, I personally feel like you've made 2 comments about how the Fed was wrong twice. I'm with you on transitory. I never thought of the prior one, to be honest. And Jimmy's talked about this mortgage-backed one, and he's dead right on that as well. But I kind of think the Fed bashing now is getting boring. And I'll take it to the point to where you said Fed funds should be at 9%. The second that the Fed says, hey, we're still willing to go higher, everybody goes nuts and said that they're idiots. They're going to ruin the economy. They have a statutory dual mandate that does not say stocks have to go up. So they've acknowledged the transitory mistake. Okay. Are they still making a mistake? And if so, is it not raising rates fast enough? Or is it just that I'll leave it there because I already went on for an hour.
Yeah, no, I think that they are making a big mistake. And again, I think that big mistake is they're not raising rates fast enough. I think they're being over-reliant on data. They're letting data lead them. And every single time in history, going back to the 1920s, where you've had significant inflation, the Fed had to lead the data. The data follows the Fed. It's not vice versa. So if they let the data lead them, we're just going to be ping-ponging all over the place. But the inflation is going to be going like this, up, not down. So I think that they're way behind. I think that the idea that they drop back, and by the way, the swaps market is now, last time I looked today, like yesterday, the odds of a 50 basis point hike in March were like 78%. A month ago, they were 9%. Today, that's all the way down. Last time I checked, to 49%. So now the odds are suggesting a 25 basis point hike because of this Silicon Valley Bank, basically bankruptcy. And I think that's just ridiculous. I think that they need to do 50 basis points. I think they're way far behind. Financial conditions, as you guys know, the Chicago Financial Conditions Index have loosened significantly. And in a nutshell, I just don't think they're doing enough. Listen, they've done a lot of quantitative tightening. But if you look at since when they announced QT, right, they've done just around 500 billion. The problem is Janet Yellen has done about 450 billion in QE. She's nearly completely offset the Fed. You can't just look at the Fed's balance sheet. You have to look at what the Treasury's doing, which effectively is QE, and also the reverse repo balance, which is effectively either QE or QT. If it's going up, it's QT. If it's going down, it's QE. So there hasn't really been QT, and their interest rate policy, based on history, i.e. they need to be above where CPI inflation is extremely accommodative still. And then on the fiscal side, you have the government, running massive deficits, issuing all this money, despite the fact we're near full employment. And you have Jay Powell saying, oh, no, they're not doing too much, which is clearly wrong. So there's just a number of places they're off sides.
So here, I'm agreeing with you 80%. There's 20% of it where I think you're crazy, and I want you to respond to it as well. Okay,
Sure.
we've just, Bobby and I are getting close to 60 years old. We've lived through 30 or 40 years of rates being held inorganically low, and an economy, an entire corporate sector that has become used to it, has become addicted to it everywhere. And all different facets of the economy are addicted to low rates. Are you suggesting that if rates are kept higher or even go higher from here, we're going to see some sort of cataclysmic implosion? Is the Fed not going to blink an eye when that happens?
You shouldn't.
No. If we see a massive event, I think they will blink an eye. I think this is the weakest Fed and the most inaccurate Fed. If you look at their dot plots, if you look at their transitory, if you look at him going down to 25 and then going back up to 50 basis points, I think this is the weakest and most inconclusive Fed that we've seen. So if you have some
Gordon,
catastrophic thing,
I'm
I
sorry
think,
to
yeah,
jump in, Gordon. If they do blink, you think it's a mistake? Am I right in saying that?
absolutely.
Okay.
Absolutely. Because
we
if you
both-
think about it, right, when we had the 70s inflation, you know, when the Fed got it wrong, and then you had inflation that stuck around for a decade. In fact, Bullard said that last week. Now, I did a piece today, one of our research notes, our Metals and Mining Weekly, we focused on M2. And if you look at M2, year-over-year M2 growth in the USA, it just went negative 2% for the first time since 1930. And
Wow.
every single time M2 has went negative, it has been followed shortly by deflation and depression, not recession, depression. And people, you might say, you know, take a look at the chart. You might say -2 isn't that bad, but the last time, the 1921 depression, that's not the Great Depression. The 1921 depression, it only took M2 in the US to go down by -2%, as we've seen today, which led to 11% deflation, 15% deflation in CPI, which created a depression. So I think the decline in liquidity is very important, and that's the QT that they're doing. But I think they should be doing more.
I'll throw something else in there with those historicals. The last time the 2-year note was at 5% was 2006. We all know what happened to equities after that. The time before that was 2000. We all know what happened to equities after that.
Right.
Otherwise, in that particular period of time, this is what Jimmy is referencing of like unnaturally low rates. To me, a 2-year note between 3 and 5% shouldn't be that shocking, because historically it's not. You go back to the 80s, 70s. I mean, granted, 70s had all that inflation, but historically having a rate that high. I'll throw out an anecdote, Gordon, and then I want to let Jimmy respond, and then I want to introduce you to Mike. I was watching a YouTube video today, and there was a real estate guy on there, and he was advising his clients to go into bonds because buying rental property right now, the math just doesn't work with rates this high. Oh my God, rates are so high. The math just doesn't work for rental properties. You just got to wait until rates go back down. What age group do you want to guess that guy was in?
I would guess 60, 65.
Opposite, 28 to 30, somewhere in that range. I tell you,
That's
a
hilarious.
lot of our parents had rental properties. Okay, Mike, as a matter of fact, who I'm going to introduce you to after Jimmy responds, his wife's parents had rental properties with 17% mortgages on them.
Yeah.
You know, so when you have these, there's a lot of people that have never experienced rates where we have them now as normal. So anyway,
Okay,
Jimmy, you wanted to respond?
So no, my last question to Gordon before we bring Mike in is this: is if I'm hearing you correctly, you are saying that there is going to be an extended period of an uncomfortable economy to get this ship correct. Is that right?
I think so. Yeah, I think the Fed is not doing enough. So I think that inflation is going to be sticky. Listen, inflation doesn't go like this or like this. It goes like this, right? It zigzags. So, you know, just like we saw with the core PCE inflation, everybody thought, you know, it went down for like, I think 2 months, and everybody said, okay, it's over. Powell said it's over. You know, 30-year fixed mortgage rates went from above 7 to around 6. You know, housing market took back off, and then they went back up, and now we're back at, you know, last time yesterday, 7.13%, you know, 30-year fixed mortgage rates. So because you don't have a serious Fed, and in addition to that, if you look at things like, you know, average hourly workings, real average hourly workings, I think it's down like 21 weeks in a row. You look at things like semiconductor imports into the U.S. or exports, they're highlighting a recession. You look at the leading economic indicators, they're all saying recession. You look at, you know, manufacturing. You look at, you know, the job cuts data that came out, right? We had the most job cuts since December of 2020. That chart's starting to go back up. You look at the quits, right? Quits are starting to decline. People are staying in their jobs more. You look at home prices, right? You're looking at, you know, total home prices in the US, that if the March number repeats the February number, we're going to have the first year-over-year decline across the US since the global financial crisis. And on and on. The data is not good, yet for some reason, a lot of pundits are saying how strong the economy is. And so I think that we're going to go through a period of weakness. And if the Fed doesn't get inflation right, listen, Charlie Munger said it, and not to say that he's the be all end all, but I agree with him. He said, the only
Yes,
thing
for
worse
me,
than
I
nuclear
love
war is inflation. I agree with him. So I think the Fed needs to get this under control. And so far, I think they're not serious.
Yeah, Gordon, I wanted to introduce you to my business partner and Path Trading Partners is Mike Arnold. Mike, Gordon, Gordon, Mike. Mike is the one who covers stocks for us. So he's interested in the stun run. He also covers Tesla quite a bit. So Jimmy, if you have any other just general economic questions, jump in. I know you can't talk on stocks. I also know you have a hard stop.
No, that's fine.
Jimmy's
you
got
go
to do
on.
Larry Kudlow's show today at 4:40.
Hey,
Right,
Jimmy,
so I gotta
nice
put
to
a
meet
nice
you,
shirt
buddy.
on. Nice to meet you. I'm going to stick around for another 10 minutes or so, though. So yeah, nice to meet you as well.
Sounds good.
So we do a live stream to some of our clients, and one of our clients, these are chat room names, so I don't mind using them. One of our clients, I said, yeah, we're gonna have Gordon Johnson on the podcast. He's like, oh my God, I hate that guy. He hates Tesla. And I'm like, oh, now I want to have him on twice, because no one's going to tell us who we can have on our podcast, right? So then somebody else followed up with a nicer question. Please ask Gordon when Tesla is going to collapse. So I'm going to start with that and then kind of let you two go, because again, Mike covers Tesla more than I do.
I'm happy to talk to the guy who hates me. I don't mind. But
He doesn't have any say on who we have on. And after this conversation, I want to have you on like 2 more days from now. But
when I think Tesla is going to collapse is, look, anybody who says, it's going to happen on, March 29th at 3 p.m., that's ridiculous. I can't tell you exactly the day or the week or even the quarter it's going to happen, but I think it's this year. And let me explain. So Tesla has engaged in margin slashing price cuts. And let me explain a little further. So in Q4, if you look at the Q4 numbers, Tesla's profit per car was around just under 10,000, right? $10,000 per car in profit, right? So far this quarter, if you include the 6% price cuts they just did in Europe 2 days ago, you're talking about just around $7,000 per car in cuts they've done across all cars. $7,000. So if you assume they get $1,000 of cost savings, I don't know how they're going to do that, but just assume that, right? You're down to 6. Let's assume they get $500 in modest price hikes, which they've announced some modest. You're down to 5.5. So if you take that roughly 9.5 minus 5.5, right? That's their profit for this year. You assume they sell 1.8 million cars. By the way, they're trending towards around 405,000 cars sold this year, which is closer to 1.6, not 1.8. But let's give them credit for their guidance of 1.8. Take that 1.8, take 9.5 minus 5.5, the price cuts they've done so far, right? And this analysis assumes they do no more price cuts the rest of this year. That gets you to an EPS number below $3, which would be declining EPS and a forward PE multiple right now of 70 times when the industry trades at six times, 70 versus 6, right? So they're having to engage in these aggressive price cuts, and they're still not selling out their capacity. All that analysis I just said is with 2 of their 4 plants, Berlin and Texas, running at 20 to 40% utilization. All right. So the point is, this company is now looking at declining earnings. They're looking at potentially flat to slightly up unit sales in Q1 versus Q4. And what I think is going to be a disaster can you guys still see me?
yeah, we got you.
Okay. What I think is going to be a disaster of a quarter in Q2. I think they will have to engage in price cuts in Q2. So all that's happening right now. I think that the margins are going to be a disaster in Q1. In Q4 of last year, their auto margins fell 300 basis points, and they only slashed prices $1,500 across all their cars. This quarter, they've slashed prices roughly $7,000 across all their cars. So I just think that Tesla is now facing a plethora of competition. They're being crushed in China. BYD is outselling them roughly 4-1. VW sells more EVs than them in Europe. And in the US, their market shares went from 80% to 62%, and GM and Ford are just getting started. So you have a company that effectively is not growing anymore. Consumer Reports, Edmunds, what's that in what's question mark? I'm sorry, which is the consumer ranking outfit in Europe, all ranks their cars quality wise dead last or close to it. Navigant just came out with their most recent ranking of full self-drive, ADAS technology. Tesla ranked last. And I think it's clear now that FSD is a joke. I think everybody who does the analysis can see that. It's been a big lie since 2016. And I think Elon Musk is, it's like the magician in the Alice in Wonderland, where you make it to the room and you pull back the curtain and it's not what you expected. I think the curtain is being pulled back. So I think a lot of things are working against them. I think, Tesla benefited from a shortage of chips earlier, in 2021 and 2022, and they were willing to ship cars without chips, ship cars excluding products that other guys weren't. That's all over now. So I just think it's going to be a very bad year for them. And I think as it becomes clear that their growth story is over, as it becomes clear that they don't lead in margins, as their margins implode, I think the stock is going to come under tremendous selling pressure.
So real quick, before I turn it over to Mike, you mentioned EPS of 70 versus 7 or 6. I'm sorry, you said 6.
A PE multiple. So
they're multiple. I'm sorry, they're multiple. What basket do you put them in? Do you put them in automakers, or you dial it down to EVs, and then you put them against the companies that make the EVs? When you say their sector or their industry, what are you talking about?
Yeah, they're an automaker. I mean, 95% of revenue.
People talk about them being a technology company, right? And I've always kind of pushed back on that.
Yeah, they're not a technology company at all. I mean, so today we found out, right? The news came out today that the 4680 batteries, they're now outsourcing to Chinese. They're looking to outsource to Korean vendors. And in the interim, they're looking to get batteries from Panasonic and LG, which anybody can buy. There's no technology there. They're buying it from other people. Their battery day that they did, they made all these aggressive claims. We now, upon the teardown of their 4680s, we found out all those claims were effectively mistruths. That's stating it nicely. So everybody said they have an advantage on batteries. We now know that's not true. Their real world range is equal or lesser to pretty much every single car out there. Their batteries are 40 volt versus the Kia batteries at 80 volts, so they charge faster. The only moat they really had was their charging stations. But Biden brought Elon Musk in and said, you have to let everybody use your charging stations. So that moat is gone. And with respect to full self-drive, I don't think I need to even go into that. Their full self-drive has been clearly unveiled as a massive mistruth that he's been touting since 2016. It's a car company. And they can continue to sell products that don't exist, like FSD, take deposits on products that don't exist, like the Cybertruck, the Roadster, etc. But I think the problem for Tesla is you have a ton of competition out there, and they're really actually investing, and they're really actually taking share, and it's showing up in their numbers.
So I'm watching my partner, Mike Arnold, smile because he says a lot of the same things you do. Mike, go ahead. Either Sunrun, Tesla, whatever you want to do.
Well, I was going to ask about the 4680 batteries, but you just covered that one because that was a big thing out today. Now, Gordon, we still potentially have more price wars in China with EVs. Right. How do you think that's going to play out and also affect China even more, or affect Tesla even more in China? And hardware for full self-driving, you've already sort of covered that I think it's a complete sham too, ever since, they went the non-LiDAR route. But how do you think hardware 4 is going to affect them? Because there's no upgrade path from hardware 3 and, all the robo-taxi promises and everything else. I'm just going to turn it over to you again.
Yeah, so with respect to China and the price wars, forget about Tesla for a second. Let's take a step back, right? If you, in 2020 or 2021, if you said EV, right? If me and you created a company and we could convince people that we're an EV company, we could literally get billions of dollars of capital, right? Money was just being thrown at these companies. Whether you're US, China, Korea, nobody cared, right? So you had a bunch of car companies literally created out of thin air, thanks to the money printing from the Fed. But the problem is, so you probably had a 3, 4, 5 times or 5-fold increase in the amount of car companies in the world. Problem is you didn't have a 3, 4, 5 times increase in the amount of people in the world, right? So simple supply demand, you now have a lot more cars chasing the same amount of demand. So inevitably, and we talked about this a lot last year, you're going to have price wars, be it in China, it's going to happen in the US, it's going to happen in Europe, it's going to happen everywhere. Because you had all these companies created because they said EV. And these companies aren't going to go down, silently in the night. They're going to lower the prices of their cars until they go out of business. So I think price wars are inevitable. With respect to hardware 4, whatever he's calling it these days, look, Tesla has cameras on their car. They took the radar off and they just have cameras. Doing full self-drive, which effectively is defined as level 5 ADAS, in my view, is impossible. So no matter what he calls it or how much hype he does, they'll never achieve level 5 ADAS with their current suite of technology. Now, he's talking about adding radar, but he's not adding LiDAR. So even when they add radar, I think they're still going to have massive problems and they're not going to achieve, level 5 ADAS. So I think that they're perpetually stuck as a underperformer and undeliverable, undeliverer on promises, if that's a word, on promises they've made and money they've taken from people on the promises they haven't delivered on. Now, will the feds ever do anything? I mean, we thought they were going to do something in 2017. They didn't. So our working assumption is that Tesla is above the law. But it's clear that they haven't delivered on things that they have charged people thousands of dollars for. And I think that could potentially be a problem when the stock falls.
What's interesting, because now that he's kind of fallen out of favor with politicians, because he's not a guy out there pushing solutions to some of the greenhouse gases, he's out there leaving Twitter to just kind of become this sort of, whatever you want to call it, whatever he's doing with Twitter. I don't want to get into that, but he's fallen out of favor of the government. So it is possible at this point, to your point, that now they start to come after him for any little indiscretion or any little thing that he might do or say that's wrong. But the thing that has always struck me, when you get these sort of Tesla cult members who maybe they like the car, maybe they like the stock, but you can't even say, I think the Porsche Taycan is better. They explode at you in a way that almost fits sort of the political vitriol that goes on now. And I'm like, what is wrong with you? It's like, if I was driving a Ford and you said you like Chevy better, I'd still go to dinner with you. Like, people get so upset. Where do you think that comes from?
They own the stock. It's simple.
They own too much of the stock.
They brought the stock at a higher price than where it's at. Or, they haven't made, 500% or like their buddies have. So they can't afford for you to say anything. Think about this, right? This is just a fact. Last time I checked, which was 2 days ago, Tesla's valued at more than the next 6 largest automakers combined. They're valued more than the next, yet they sell just 4% of the cars that those automakers have sold on a trailing 12-month basis. So if they're not growing exponentially, not just growing exponentially, but if you don't believe they're a tech company, a solar company, you got to do all these things to get to the valuation to make it make sense. The stock will come tumbling down. So if you say any bit of truth, I think that the fanboys / stock owners get upset. And I think that's really what it boils down to.
And honestly, for anybody watching this now who is one of those people, this literally fits into that basket of never put too much into one place. And don't fall in love with a stock, for fuck's sake. If you're going to invest in something, if and when it doesn't go your way, you'll always have a trade that doesn't. Realize it and get out. Don't fall in love with these companies. Go ahead, Mike.
Real quick, you just mentioned solar. I'm going to make a transition now because Sunrun's another company that I've talked to them about solar leasing and a bunch of stuff, and Sunrun's in my garbage list. I know you've tweeted about them before, and now today I've just heard that they have some issues and exposure to Silicon Valley Bank. Is there anything you know about that? I know you've been questioning the CEO about the way that, and really with the IRS, how they do some things. I haven't gotten into it as much as you have, but I'd like to hear some more information with respect to Sunrun.
Yeah, so Sunrun needs to perpetually raise debt. They need to perpetually tap their warehouse facility every quarter. And the question we had and have is, due to the Silicon Valley Bank basically bankruptcy, and because they're a corporate banker to Sunrun, and Sunrun just put out a sheet saying that they have $80 million of cash at Silicon Valley Bank, which they're probably not going to be able to get back. And of the $720 million of warehouse facility debt they have access to right now, Silicon Valley Bank was 40 million of that. They're not likely not going to be able to access that. Our question is, can you continue to access that warehouse line? If the answer to that is no, if for some reason, because of this bankruptcy, they can't access that warehouse line, by our calculations, Sunrun burns without issuing perpetual debt $114 million of cash a week. So what that equates to is about 6 weeks of cash that they have left. They have 720 million on their balance sheet. So I'm not saying this is the case. You know, people asked the company this, they didn't answer it in their white paper today. But if they can't access that warehouse facility for any reason, right, contractually, whatever, and they can't do it for 6 weeks, they're literally out of cash. That's the definition of insolvency. I'm not saying that's going to happen, but that's important. And what's very important about all this is Sunrun's business, in our view, is like a mad science project. They hemorrhage cash. They burn about their free cash flow with debt leverage is about 900 million of free cash flow burn a quarter. Their EBITDA is negative, and they don't earn their cost of capital. And you know, effectively, what they do to keep all this going is the actual cost of their systems that they show in their financials is $3. But then they use this cockamamie residual value calculation. It's this 30-year DCF that has all these ridiculous assumptions. Like, for instance, they assumed that their cost of capital, complete debt and equity, was 5%. When treasuries are at 5%, that is crazy. Like, equity costs more than debt. If treasuries are at 5%, that means your cost of your equity is probably around 12. But so they put that in this cockamamie model. They assume 0% default rates for 30 years. They assume 90, so nobody's ever going to default on the solar loan, ever. They assume 90% renewals on technology 30 years into the future. So you're going to renew the system on your roof, which, by the way, a roof only lasts 15 years. You're going to renew that in 30 years, 90%. And then so they do this calculation. So the price that they show to the IRS using all these inputs is like double what the actual cost is, which, by the way, based on current IRS regs, is illegal, we believe. So, you know, it's like business models like this don't last. And what's kryptonite to these guys is higher rates. And, you know, you're seeing that with this SVB. So the question is, do they have access to their warehouse line? And if they don't, will they have access in 6 weeks? And if they don't have access in 6 weeks, I think you're going to see some fireworks. That's what we were focused on today.
Gordon, what do you like, if anything, in the economy right now? Is there any sort of sector, or go ahead?
Yeah, we have a buy rating on Cameco, which is your uranium play. We like uranium because, you know, whether you agree with climate change or don't agree with it, I think that it's going to be around as far as politicians pushing it for a while. So if you want real solutions to climate change, solar and wind just aren't real solutions. In fact, they're quite harmful. I think the entire Russian invasion of the Ukraine would not have happened if the EU wouldn't have pushed so aggressively into, you know, unreliable, unstable energy sources like solar and wind, right? They shut down coal, they shut down nuclear, and they went solar and wind. Solar and wind are unreliable and unstable. So what did they have to do? They had to go buy gas from Russia. Russia made a ton of money. EU became dependent on them, and it emboldened them, in my view, in our view at GLJ, to invade the Ukraine. So the reality is, like, solar and wind just aren't a real solution. And people say batteries, it's just crazy. Like, if you do the math on batteries, you're talking about, we'd have to spend like double our GDP to power like just California. It's the technology is just not there. And by the way, lithium batteries aren't made for storage. But anyway, so when people get real, right, and say, okay, what can we do to actually reduce emissions, but something that makes sense? It's nuclear. And I think that we're moving that way. And I think when we move that way, there'll be the new rock star stocks. So that's why we like it. It's a longer term play. It's not something that you're going to make money on probably in a quarter. That's not our call, but we think it's going to be a very good opportunity over a longer period of time.
So I like gold for this year. Am I nuts?
I believe, well, it depends on what happens with rates. If you had asked me that 2 days ago, I'd say you're definitely nuts, because I would say that rates are going higher. If real rates are going up, gold is going down. If real rates are going down, gold is going up. But now with this Silicon Valley Bank, we'll see what Powell and, you know, the Fed hint that they're going to do. If they're going to stick with 50 or go 25. But if they go back to 25, yeah, gold will do well. If they stick with 50, gold won't do well. So it depends a lot on Powell and what he decides.
Yeah, I mean, my thesis comes from looking at gold during stagflation periods, really, because that's what I think we're headed into. And really, I mean, I don't hold anything. My average hold time is probably about a month and a half. So we kind of got a different time frame. But gold, I wanted to hold for this entire year because my base thesis is stagflation. It really is. I think we end up with a slow economy. And I don't think they have the balls to do what they need to do. And I constantly hear, and again, my friend Jimmy's one of them, and we argue about it all the time, that, you know, the Fed needs to stop because they're going to break something. Well, Jimmy owns a restaurant. You know, of course he doesn't want the economy to fall, you know, into recession. And Elizabeth Warren, you know, saying to Powell, it might have been Warren, it might have been the other one, I don't remember the other senator's name, saying to Powell, what do you say to the 2 million people who are going to be out of work? And I wanted him to turn around and say, what the fuck do you say to the 333 million people that are suffering under inflation?
Boom,
Like,
that was my
inflation
exact comment.
is way worse than
Yeah.
a 6% unemployment rate. It's way worse.
Yeah, dude, you took the words out of my mouth. I tweeted that to Elizabeth Warren. And I think Powell said that himself.
He did it in a very diplomatic way.
It's like the pot calling the kettle black, right? I mean,
Yeah.
she voted for all of this massive fiscal stimulus, which that's what really created the inflation, right? When Powell was doing QE, it created inflation, but it created inflation in financial assets, stocks, and housing, right? What created the everything inflation was this fiscal stimulus that she continues to argue for, like, you know, forgiving student debt and giving people, you know, checks out of thin air, and all this free house, you know, forgiving people's rents and all. That's what created the everything inflation. So it's really rich that she, you know, lambasts him when she voted for all these bills that really contributed to the inflation we're seeing today.
And
Now, keep in mind,
student loan forgiveness would be inflationary, right?
Yeah, the government can't do this fiscal stimulus without the Fed printing. So ultimately, it all goes back to the Fed, right? Okay. They can't do these $1 trillion bills without the Fed printing the money to do it. So the Fed could really stop all of this if it wanted. But, you know, it's just rich that she takes no liability or no credit for the inflation we're seeing.
I don't know. I mean, does the Fed have the authority, if the federal government, if Congress passes stimulus checks mailed directly to the people, does the Fed have the authority to say we're not printing those?
I don't know. I think the answer is yes. They're by law, they're supposed to be independent, but you know, reality and laws can be quite different. So they do have the authority, but they just haven't had the moxie, if you will, to do it.
Mike, you got anything else?
No, I'm good. You got my questions out of the way.
All right. So last question then, and we'll let you go, Gordon. We really want to appreciate it. We really want to appreciate it. We really appreciate it. See, that's not going to get edited out. I'm just going to look stupid and look like I stumble over my words. We really, really appreciate taking this time, man. We'd love to have you back. My last question for you is, where do you see rates and the equity? And you don't need to nail a time or a date or an exact target, but if I say by, let's say December, you see rates higher and stocks lower, rates here and stocks lower, what's the combination you see?
Yeah, the rate thing is very hard, but I think stocks are going to be substantially lower. And I think that what's going to happen is you're going to have, well, I would argue then rates are going to be lower. So again, the analysis we did with money supply now contracting, I think that what Powell may do because of the Silicon Valley Bank thing is he may, you know, go back to 25 bips and maybe even go to flat, but he may increase the amount of QT. And I think the focus on rates is wrong. I think what's going to affect stocks the most is the pace of quantitative tightening. And again, with money supply now negative 2%, M2 money supply in the US, the first time since 1930. Again, you can, I'll send you guys the charts. You just look at money supply and then look at CPI going back to 1910. You'll see what I'm talking about. I think we're about to get eventually significant deflation, which is going to create significant job cuts, which is going to send us into recession/depression. And I think that, I shouldn't say depression, that sounds too draconian, recession. And I think that that's going to result in significantly lower stocks. Look, in bear markets, you have massive rallies. And I think from, was it 2000 to 2002, I think the NASDAQ was down, I think, was it like 30 or 40%. But over that time frame, I think you have 4 rallies of up 20%. So you're going to have nasty rallies that, fool people. But where we're headed, I think, is significantly lower. And I think, again, a big part of it is the liquidity aspect.
Yeah, the bear market in the 99, 2000, 2001, we were down almost 70%. We had 4 rallies over 20%. We had 1 over 40% before the entire downdraft was done. That's something I got. Cameron Dawson sent me a chart on that. So if you can, Gordon, please, number one, send me that chart and we'll put it up in the podcast. And then I'll tweet it out with the podcast link.
I'll shoot you the note we did today.
And then lastly, where can people find you if they need to find you, want to find you? Tell everyone how to find you.
Yeah, Twitter. You can find me on Twitter, Gordon Johnson. It's at Gordon Johnson 19. The firm and my team are at GLJ_research.
Sounds good, man. Dude, thanks again. And look, if you hate Gordon, he's willing to talk to you. So reach out to him.
I'm willing to talk to anybody. I don't hate anybody. You can't have emotion in this market. You got to in markets. You got to just roll with the punches, if you will.
You got to have thick skin. If you're going to attach your own personal worth or intelligence to one trade, get out of this business. Just get out.
I agree. What I'll say, one last thing I'll say.
Yeah, please.
If Powell comes out tomorrow and says, we're going back to QE, rates are going back to 0, Tesla's going higher. And we have to acknowledge that, right? Yeah. We didn't acknowledge that the first time around. So we're not I believe fundamentally the stock is headed a lot lower, but people say, what would change your view? Number one, what would change my view is if their earnings inflected higher and their growth inflected higher. But number two would be a Federal Reserve who said, you know what, we're going back to easy money, free money. That would change our view as well.
Dude, thank you so much for being here, man. This is fantastic. And I'm gonna put out the invite right now. We want to have you back for sure.
All right, sounds good.
All right, brother. Thanks again, man. Cheers.
Absolutely. Take care, guys.
Bye.